Hello, it's Jonathan Wellham of Rocklinc Investment Partners, and it's March the 15th, 2018. Now, this will be our second video discussing our new Rocklinc Partners Fund. And we're going to, as I said in the first video, which was really an overview, talk about each of the 8 major sectors that we're investing in over the next number of weeks. And this week, we want to talk a little bit about the infrastructure sector. So on the first slide, I just remind you again of our Rocklinc Partners Fund and the overall presentation that we're going to be embarking on over the next number of weeks. We're going to talk about the fund, a little bit about investment process, which we really focused on last week. And more importantly, we're going to zero in now on the sectors of focus and the different investment strategy and holdings that we actually have in the fund. On the next slide, just a quick reminder of the Rocklinc Partners Fund. This is a no load, no performance fee. It's priced once per month with monthly liquidation or monthly redemption opportunities. And then we have 2 main series of funds. One for very large investments, which would be charged a management fee of 0.75% per year, and then for smaller investment sizes, we would charge 0.95% per year. So again, that's just by way of reminder in terms of the overall portfolio. On the next slide, we talked about this in more detail last week in our first video of this series. And we talked about our investment process, and I just highlight numbers 4 and 5 there. We look for industries with above average growth and invest in businesses with high returns on capital. And then on the next 2 slides, which we talked about in our first video also, we just highlighted the 8 industries where we have the preponderance of our investments. And so what we wanted to do, because of the detail, was just to take one industry at a time. So on the slide before you, you can see that the industries are infrastructure, financial, technology, manufacturing, and we're going to highlight infrastructure this week. On the next slide, we talk a little bit about precious metals, healthcare, agriculture, and water. So let's get right into infrastructure now in terms of this particular video, and just highlight really some of the reasons why we are investing in infrastructure and what type of companies are represented in that sector. So infrastructure. Now on the slide before you, there's some nice pictures that give you a feel for what infrastructure assets are. But really, infrastructure assets, as I think most people know, really form the backbone of the global economy. And they enable the delivery of essential products or services. And according to the experts, there's quite a shortage, if you will, or a shortfall in terms of the kind of investments we should be making in infrastructure. And I think you probably hear governments all around the world talking about all this infrastructure spending they want to do. One of the problems is they don't have much money, and we think that this is going to provide a great opportunity for companies in the private sector that can run and manage and buy infrastructure assets. And so on that slide, as you can see, the estimate is there's about a $25 to $35 trillion US gap, infrastructure gap, that's going to have to be bridged over the next 25 years. Now let me just, before we look at the companies that we are investing in that are sort of more pure play infrastructure, just remind you that infrastructure assets are essential. They're essential services. They involve things like transportation, roads, airports, rails, ports, renewable energy, and we'll talk a little bit about that, all of the various areas of renewable energy, from solar to wind to geothermal. And one of the reasons why we like the sector itself is it provides stable growth, and growth it provides, but stable, solid diversification, because we can buy assets that are in various infrastructure subsets, like energy or wireless towers or things like ports. And we can also buy assets that are geographically diversified, so we're not just taking the risk of one country. And that's also important in terms of diversification. Steady income And in many cases, the income is hedged to inflation. A lot of the cash flow contracts that are signed by the infrastructure companies provide an inflation hedge. And that can be very important, especially if we are entering a period where there's going to be more inflation. On the next slide, you just highlight sort of the three companies that we're going to zero in on in terms of our main infrastructure companies. Now it would include Brookfield Renewable, Brookfield Infrastructure, and Choice Properties. So let's just jump right into it. Brookfield Renewable Partners, that's the slide that you have up in front of you. This is a company that focuses on renewable infrastructure assets. The company actually has its roots that go back over 100 years, so this is a company that's been around for a long time. And it maintains one of the world's largest portfolios of renewable energy assets with over 16,000 megawatts of energy, whether that comes through hydro electricity, in other words, waters, river systems, wind, solar, and geothermal sources of energy. Now, they have assets in 3 different continents and over 14 countries. In fact, they actually have 841 generating facilities in North America, South America, Europe, and Asia. So this is one of the largest publicly traded renewable energy companies in the world. 80% of its portfolio is in the area of hydroelectricity, and they have assets in 81 river systems in various countries that they operate. And they have over 40 billion in total power assets. And so this is a sector that continues to grow and continues to expand, and Brookfield is really well placed. They're very capable operators. They're owner operators, which is important, so they understand the assets well. And they have a very strong balance sheet and low cost of capital, so they can continue to buy assets as they become available. They can continue to grow their different sites and generate more and more energy, which would be organic growth over time. So we really like this company. It currently has a dividend of $1.96 US per share. And when you convert that over to a dividend yield in Canadian dollars, it's well over 6%, so a very strong dividend yield. The next company is Choice Properties. And Choice Properties is a real estate company. It's a 100% Canadian-based real estate company, and it's part of the Weston Empire, if you will. The company has its genesis with the real estate that was within the Loblaws group of companies. And so its first tenants were all of the various Loblaws food retailers, you know, the Fortinos, the Zehrs, the Supercenters, and so forth. And so it's one of the largest landowners in Canada. So as we highlight on that slide, it's very well run real estate investment trust, or REIT, 752 retail mixed use properties, and predominantly, again, grocery store anchored as a result of its roots in Loblaws or within the Weston group of companies. It's also a very predictable business, which is what we like, and so we're looking for the cash flows to pay good dividends. And this is a company that pays 74 cents a share, trading a little over $11, which gives you, again, in excess of 6% dividend yield. Now recently, just in the last few weeks, the company just purchased, and you see this on the slide, Canadian REIT for about $3.9 billion. And this makes them Canada's largest diversified real estate investment trust, and gives them amazing diversification across the country and across various tenants and businesses that they would provide real estate for those particular businesses. And so as we point out on the slide, this is a major player, low cost of capital, opportunities for development growth, opportunities to continue to expand their real estate holdings over time. And so again, we like this company. It provides a great basis for one of our infrastructure companies. The last company I'm just going to highlight, which has been an important company in our group of investors' portfolios, is Brookfield Infrastructure Partners. And you see the slide in front of you there. This is a major player, and these would be infrastructure assets outside of renewable energy where its sister company operates, which we talked about already. This has about 43 billion in assets under management. And you know, if you look at, you can look at the slide and see what we've written there, but just in its utilities area alone, it operates in 6 countries and in 4 continents. It is a transportation business that has 37 ports in North America, the United Kingdom, and also Australia. Has over 4,000 kilometers of toll roads in South America and in India. Has communication towers in France. In fact, there's over 7,000 communication towers in active rooftop sites and over 5,000 kilometers of fiber optics. And so this is a major infrastructure company. It's very well run, and it's got tremendous leverage to the growth in the global economy, as we point out on this slide. And so it's again an owner-operator company, which we really like. The current dividend on this company is $1.88 US per share, and that translates into just under 5% dividend yield. And so infrastructure will remain for the foreseeable future one of the key areas that we continue to invest in. It provides us great, stable, long-term, diversified growth with a hedge against inflation. And at the end of the day, when you have companies that have strong balance sheets in the infrastructure area, they're anchored in hard assets, physical assets, essential assets. And these are just a handful of the companies that are really direct players in the infrastructure space that we currently have investments in. So hopefully that gives you a better sense of the infrastructure area and why we're in that sector and why we continue to look for opportunities in the infrastructure sector. Thank you very much for listening. Next week we will look at the financial sector. Have a great rest of the week. Thank you. Bye now.